Hello everyone, welcome to Mr. Wong's Financial Classroom. Today's video is mainly to share with my Canadian friends and my Canadian family, because what we're going to talk about, it's only applicable to someone who lives in Canada, right? So today I'm going to share with you, should I invest in RRSP, TFSA, or non-registered account? Because many people have been asking me, what are the differences? So many different accounts. If I'm new in Canada, I'm a resident here, but I don't know where to start. So today I'm going to show you the differences and the benefits of each one. Okay. Now I'm going to show you this slide. It's going to take a while, if you read it through. If you want, you can take a screenshot on my video and see all the differences between RRSP and TFSA right here. Okay, let's go with RRSP first. The purpose of RRSP is to use to save for retirement. Okay, the name RRSP means Register Retirement Saving Plan, right? So how do you create the contribution room? How much are you allowed to contribute the room? RRSP, you gotta have earned income in order to be eligible to contribute. Earned income means your salary, your business income, etc., but not rental income. Okay, not rental income. Maximum age to contribute, you can keep your RRSP account until you are 71 years old. After that, you're allowed to convert it to RRIF, Registered Retirement Income Fund, RRIF. All right, and in the future, I might want to, if I have a chance, I'll share with you more about RRIF, but not today. The deadline to contribute usually is the last day of February. Okay, the last day. Then you can deduct your income tax for the previous year. Any annual contribution limit, the lesser of 18% of earned income, 18, or this year, 2022, the dollar amount is $29,210. Right? That means what? If you make $50,000 earned income, 18% is $9,000. That means the maximum you can contribute is $9,000. But if you're a high income earner, you make $200,000. Okay, the maximum dollar amount you can contribute to RRSP is the maximum dollar amount of $29,210. So no matter if you make $500,000 or whatever or more, the maximum amount is $29,210. All right. You cannot over contribute because there's a tax penalty, 1% tax penalty per month, right? But each body is allowed to have a lifetime, over contribution of $2,000. That means you can over contribute by $2,000, no more than $2,000. If you contribute more than $2,000, you're gonna get tax penalty, right? The contribution room. All right, if you do not contribute to RRSP this year, the contribution room from this year can be carried forward until next year. All right, in the future, if you ever need money, you want to withdraw money, the contribution room, once you contribute, it is permanently lost. You will not get it back, right? Upfront tax advantage. Upfront, that means when you make contribution, the advantage is all the money you put into RRSP, your contribution is 100% tax deductible. to lower your taxable income, right? 100% tax deductible. Future tax advantage, the money in RSP account, no matter how much interest you make, is tax deferred. That means deferral. You don't have to pay any income tax, defer, okay? But when you withdraw your money, every dollar become your taxable income, right? So you have to be very careful. The beginning and the end. Beginning is the contribution, is tax deductible. The end is when you take money out, it's taxable. So some people ask me, so what's the point putting money in RSP? I have to pay tax annually. I mean eventually. No, if you keep investing in RSP, if you are young, 30 years old, 35, or even 40, 45, you don't need your money. You probably don't need your money like 20 years later, 30 years later. Then you keep deferring your the income tax, and the money sitting in your RSP account, they keep earning more interest, compounded interest, more and more. So that makes a big difference. I'm going to show it to you later. So on the other side, TFSA, tax-free saving account, is basically anybody can contribute. If you're 18 years old, okay, from 18 years old, if you have a social insurance number, and if you are a resident of Canada, you can contribute, right? So maximum age to contribute, none. That means you can contribute until, if you're 99 years old, if you're still alive, you can still contribute to TFSA basically. Deadline, there's no deadline. Unused contribution room, if you do not contribute, the room will be carried forward till next year, right? So annual contribution limit, yes. This year, 2022, the maximum amount you can put into TFSA is $6,000 for this year. But like I said, if you did not contribute to TFSA in the previous years, the room will be carried forward, right? So your total amount of allowable contribution room might be more if you did not contribute in the previous years. And if you over contribute, there's also 1% tax penalty, right? So be careful. You can carry contribution room forward, yes, forever. Okay, if you withdraw your money, this is something a little different than the RSP. If you withdraw money this year from TFSA, say if you withdraw $5,000, right? And then next year, this $5,000 will be added to your contribution room for next year. That means next year you're allowed to contribute $5,000 more because you have withdrawn $5,000 this year. Oh, this is something very unique. Okay. Upfront tax advantage? No. You contribute to TFSA is not tax deductible. You cannot deduct your income tax, all right? And then when you withdraw your money in the future, it's totally tax-free. So like I mentioned before, beginning and the end. For TFSA, the beginning is not tax deductible, but at the end it's tax-free. All right. So I have some note under here. For RSP, we also have RSP home buyers plan and lifelong learning plan. Those are different. Like for home buyers plan, you're allowed to withdraw a certain amount of money out as down payment for your next home. But you have to be the first home buyer, okay? Then it's not not taxable, the money you withdraw, but you have to pay back. If I have the chance, I may share with you more about home buyers plan and lifelong learning plan in the future, right? All right, let's look at the slide here. Look at the RRSP contribution example, right? Before RRSP contribution, say last year, 2021, your taxable income is $50,000. Taxable income means after all the deduction, this is the income, $50,000, to calculate how much tax you have to pay, right? So based on that, your marginal tax rate would be 28.2%. That means you have to pay $14,100 tax. Wow, that's quite a lot, right? So your net income is only $35,900. Okay, if you make a RSP contribution of $9,000, so after RSP contribution $9,000, your new taxable income will be reduced to $41,000. Because the contribution is tax deductible, and that will lower your marginal tax rate. Okay, because you are in a lower tax bracket, so your new marginal tax rate is only 22.7% versus 28.2% before contribution. So tax payable is $9,304, right? So you save a lot of income tax, and you have more net income, for $40,000, $696 net income versus only $35,900, right? So you save that much money, and plus, like we mentioned before, the money in RSP account, the interest earned is totally tax deferred, right? Tax shelter, or another term we want to give it to tax defer. But the problem is, where do you get that $9,000 to contribute to RSP account? You have to either you have your own saving, if not, some financial institution, some banks are willing to lend you money. They call it RSP loan. They charge you little interest. So I would encourage, if you have a tax problem, if you want to get your income tax refunded to you, and you don't have $9,000 in your bank account, I still encourage you to borrow money, because you pay a little interest to the bank, you get more tax refunded to you from government, right? And then the money refunded to you, you can invest it, and you can earn more interest from that kind of money. So now look at an example of registered account RSP versus non-registered account. You know, annual deposits is $8,100, right? That means every year you put $8,100 in either RSP or non-registered. Non-registered account means all interest earned is taxable immediately. You have to pay tax in that year. That's why you look at the balance on both sides. Okay, non-registered account is much less. In this example, I assume that both accounts have the same annual rate of return of 8%, and you are at marginal tax rate of 35%, right? So just give you an example. By saving some income taxes, it will generate more money for you in the future when you really need your money, right? So 15 years later, in RSP account, you have $237,526. If you invest the same amount of money in a non-registered account, 15 years later, you only have $186,667. The difference is $50,850. 50,000, more than 50,000 difference. Okay. This slides we can quickly go over. It's a basic same idea. Registered account, TFSA versus non-registered account. Okay, we all know that the difference is you pay tax or you don't pay tax. All right. So I hope the information today will give you a better idea of this, the differences of this account. And thank you for watching. If you like my video, please subscribe to my YouTube channel, Mr. Wong's Financial Classroom. I will have more video to share with you in the future. Thank you and have a good day.